What if I told you that banks make billions of dollars every year using this simple trick, and most people don't even realize it? In this video, I'll explain Personal Loans Explained, what banks don't tell you, in the simplest way possible. No confusing terms, no financial advice, just education to help you understand how the system really works. What personal loans actually are, and why they exist. A personal loan is one of the simplest financial products on the surface. You borrow a fixed amount of money, you agree to repay it over time, and you pay extra money on top of what you borrowed. That extra money is the entire reason this system exists. Personal loans were created to solve a real problem. People sometimes need money before they earn it. Unexpected expenses, large purchases, short-term financial gaps. Instead of waiting years to save, the system allows you to pull future income into the present. That sounds helpful, and it can be, which is why millions of people use personal loans every year. But here's the important part most people don't stop to think about. A personal loan is not just money. It is a contract that changes how your future income behaves. Once you take a loan, a portion of your future earnings is already spoken for before you even earn it. That's the core concept. Not good, not bad, just a mechanism. And mechanisms always benefit whoever designed them well. How the personal loan system works, step by step. Let's break the system down calmly. First, money is created or allocated by financial institutions. This money is not idle, it is designed to move. When you apply for a personal loan, the institution is not asking, does this person need money? They are asking, can this person reliably send money back every month? Because the real product isn't the loan. The real product is your future cash flow. Here's the flow. You receive money up front. You commit future income to fixed monthly payments. Interest stretches the repayment beyond the original amount. Time works in favor of the institution, not the borrower. From the system's perspective, this is extremely efficient. Why? Because payments are automated. Risk is spread across millions of borrowers. Small percentages become massive totals at scale. Even a modest interest rate, when applied consistently over time, generates predictable revenue. That predictability isn't accidental. The system is designed to prefer stability over flexibility, long-term commitments over short-term relief, rules over emotions. And most people don't interact with the system. They interact with the monthly payment number. That's where confusion begins. Because when you only look at the payment, you stop seeing the full structure behind it, how small, unnoticed actions turn into long-term losses. Most people don't make mistakes because they are careless. They make mistakes because the system feels simple when it's actually layered. Let's look at the most common patterns. Mistake 1. Focusing only on the monthly payment. This is the most widespread misunderstanding. When people consider a personal loan, the first question is usually, can I afford this monthly payment? The system encourages this thinking. But the monthly payment hides two important realities: how long the commitment lasts, how much total income is being redirected over time. Because the payment feels manageable, the obligation feels small. In reality, it's not a monthly decision. It's a multi-year income decision. And most people never consciously frame it that way. Mistake 2. Treating borrowed money like earned money. Money received from a loan feels the same as money earned. It enters the same bank account. It buys the same things. It creates the same emotional relief. But functionally, it behaves very differently. Earned money increases flexibility. Borrowed money reduces future flexibility. That difference isn't obvious at the moment of spending. It only becomes visible later, when income feels tighter for reasons that seem unclear. Mistake 3. Assuming stability in an unstable world. Personal loans are built on one silent assumption, that your future income will remain stable. The system needs consistency. Life rarely provides it. Changes don't have to be dramatic. Slight income delays, temporary expenses, small lifestyle shifts. Individually, these feel minor, but fixed obligations don't adjust emotionally. They remain fixed, regardless of circumstances. This mismatch is where pressure quietly builds. Mistake 4. Underestimating time. Time is the system's strongest advantage. Interest doesn't need to be aggressive to be effective. It only needs to be consistent. Small percentages, stretched across long periods, feel invisible month to month, but significant when viewed as a whole. Most people never calculate the full picture. not because they can't, but because the system never requires them to look at it. Mistake 5. Believing mistakes are personal failures. One of the most damaging misunderstandings is emotional. When people struggle with loan pressure, they often think, I mismanaged, I made a bad decision, I wasn't disciplined enough. But the system doesn't rely on individual failure. It relies on average behavior, predictable habits, emotional decision-making, short-term relief over long-term clarity, which means many people experience the same stress, independently, without realizing it's structural. Not avoiding systems, avoiding emotional reactions. People who handle financial systems well are not smarter. They are calmer. They don't try to escape systems. They try to understand the rules before reacting. Because panic is expensive, smart users recognize one key idea early. Systems don't respond to emotions. They respond to structure. Personal loan systems reward predictability, consistency, rule-based behavior. They punish urgency, short-term relief thinking, emotional decision loops. This isn't moral. It's mechanical. Discipline over feelings. Most people interact with money emotionally. Relief when money arrives. Stress when payments repeat. Anxiety when obligations feel permanent. Smart system thinkers separate emotion from structure. They don't ask, how does this feel right now? They ask, how does this behave over time? That shift alone changes outcomes, not because of action, but because of interpretation. Mental Model 1. Institutions think in flows, not moments. Financial institutions do not think in months. They think in lifetimes, aggregates, probability distributions. One individual loan doesn't matter much. Millions of similar behaviors do. This is why systems are designed to appear simple, repeat reliably, scale without friction. Understanding this removes personalization. The system isn't against anyone. It simply favors patterns that repeat. Mental Model 2. Control comes from rules, not force. Most people think control means power. In systems, control comes from rules that don't need enforcement. Automatic payments, fixed schedules, predefined consequences. Once a rule is accepted, the system no longer needs persuasion. This is why smart users respect the design, not the branding. They look past marketing language, friendly interfaces, short-term incentives, and focus on what stays unchanged over time. Mental Model 3. Long-term clarity beats short-term relief. Short-term relief feels like progress, but systems measure success differently. They measure duration, consistency, compliance. Smart thinkers understand that relief is emotional, while structure is mathematical, so they don't chase comfort. They observe patterns. And observation creates distance. Distance reduces mistakes, seeing the long-term impact clearly. When someone truly understands how a system works, something important changes. They stop seeing money as random, emotional, intimidating, and start seeing it as logical, structured, predictable. Personal loan systems don't gain power from complexity. They gain power from being misunderstood. Once awareness is present, fear reduces. Not because obligations disappear, but because uncertainty does. What changes when awareness appears? Before understanding the system, payments feel heavy, time feels slow, pressure feels personal. After understanding the system, obligations feel mechanical, time feels measurable, pressure feels explainable. This doesn't make the system weak, it makes your perception stronger. And perception is where control begins. From fear-based thinking to logic-based thinking. Most stress around money comes from not knowing how long something truly lasts, what is fixed versus flexible, what is emotional versus structural. When money is viewed emotionally, every obligation feels urgent. When money is viewed logically, obligations become data, not threats. That shift alone changes how people relate to systems, not by rebellion, not by avoidance, but by clarity. Big picture takeaway. Systems don't need you to fail. They only need you to not fully understand. Once understanding exists, confusion drops, emotional mistakes reduce, decisions feel slower, calmer, clearer. And that's the real difference between feeling trapped by a system and simply operating within it knowingly. If this helped you understand the system better, consider subscribing for more educational breakdowns like this.